Hello guys, welcome to our video. On today's video, me, Warda Fahira, and my partner Naomi Romandang will explain to you the material related to financial reporting and analysis. So enjoy the video. Primarily, the financial statements are the most important product of financial reporting environment. Information in financial statements is judged relative to, first, the information needs of financial statement users, and second, alternative sources of information such as economic and industry data, analyst report, and voluntary disclosures by manager. Statutory financial reports. Statutory financial reports are the most important part of the financial reporting process. While we are familiar with the financial statement, especially the annual report, there are other important statutory financial reports that an analyst needs to review. We examine three categories of these reports in this section. First, financial statements, second, earnings announcement, and last, other statutory reports. Financial statements. The statutory equivalent to the annual report is the Form 10-K, which public companies must file with the SEC. Form 10-K usually contains relevant information beyond that in the annual report. Companies are also required to file Form 10-Q quarterly with the SEC to report selected financial information. It is important to refer to Form 10-Q for timely information. Unfortunately, most companies release very condensed quarterly information, which limits its value. When analyzing quarterly information, we need to recognize two crucial factors. First, seasonality. When examining trends, we must consider effects of seasonality. For example, retail companies make much of their revenues and profits in the fourth quarter of the calendar year. This means analysts often make comparison with the same quarter of the prior year. Second, year-end adjustment. Companies often make adjustments in the final quarter. Many of these adjustments relate to the entire year. Next is earnings announcements. Annual and quarterly financial statements are made available to the public only after the financial statements are prepared and audited. This timeline usually spans 1 to 6 weeks. Yet companies almost always release key summary information to the public earlier through an earnings announcement. Earnings announcements provide key summary information about company position and performance for both quarterly and annual periods. Then, other statutory reports. Beyond financial statements, companies must file other reports with the SEC. Some of the more important reports are the proxy statement, which must be sent along with the notice of the annual shareholders meeting. Next is Form 10-K, which must be filed to report unusual circumstances such as an update or change. And next is the prospectus, which must accompany an application for an equity offering. Now we're going to talk about factors affecting statutory financial reports. First, Generally Accepted Accounting Principles or GAAP. There are two commonly standards that we use. First, US GAAP, which refers to the rules and practice that are currently in use in the United States. And second, IFRS, which refers to rules and principles that are laid down by the International Accounting Standard Board and adopted by the most of countries outside the United States. Second factor is managers. Primary responsibility for fair and accurate financial reporting rests with managers. Managers have ultimate control over the integrity of the accounting system and financial records that make up financial statements. Recognizing this fact, the Sarbanes-Oxley Act of 2002 requires the CEO to personally certify the accuracy and veracity of the financial statements. The last factor is monitoring and enforcement mechanism. Monitoring and enforcement mechanism ensure the reliability and integrity of financial reports. Some of these, such as the SEC, are set by the Fed. Other mechanisms, such as auditing, evolve over time. The importance of this mechanism for the credibility and survival of financial reporting cannot be overemphasized. This factor is including auditors, corporate governance, Securities and Exchange Commission or SEC, and litigation. The next section is nature and purpose of financial accounting. Qualities of accounting information. First quality is relevance. Relevance is the capacity of information to affect a decision and is the first of two primary qualities of accounting information. Second is reliability. Reliability is the second important quality of financial information. For information to be reliable, it must be verifiable, representational faithfulness, and neutral. Next, comparability and consistency are secondary qualities of accounting information. Comparability implies that information is measured in a similar manner across companies. And last, consistency. It implies the same method is used for similar transactions across time. Accounting principles. First principles is accrual accounting. Under accrual accounting, revenues are recognized when earned and expensed when incurred, regardless of the receipt or payment of cash. Next is historical cost and fair value. Traditionally, accounting has used the historical cost concept for measuring and recording the value of assets and liabilities. Historical costs are values from actual transactions that have occurred in the past. So, historical cost accounting is also referred to as transaction-based accounting. Recognizing the limitation of historical cost accounting, standard setters are increasingly moving to an alternative form of recording asset or reliability values based on the concept of fair value. Fair value are estimate of the current economic value of an asset or liability. The third principle is materiality. Materiality, according to the FASB, is the magnitude of an omission or misstatement of accounting information that, in the light of surrounding circumstances, make it possible that the judgment of a reasonable person relying on the information would be changed or influenced by the omission or misstatement. The last principle is conservatism. Conservatism involves reporting the least optimistic view when faced the uncertainty in measurement. The most common occurrence of this concept is that gains are not recognized until they are realized. Conservatism reduces both the reliability and relevance of accounting information in at least two ways. First, conservatism understates both net assets and net income. The second point is that conservatism results in selectively delayed recognition of good news in financial statement, while immediately recognized bad news. Accrual concept. An appealing feature about cash flow is simplicity. Accrual accounting aims to inform users about the consequences of business activities for companies' future cash flows as soon as possible with a reasonable level of certainty. Accrual process. First process is revenue recognition. Revenues are recognized when both earned and either realized or realizable. Next is expense matching. Accrual accounting dictates that expenses are matched with their corresponding revenues. There are two kinds of accruals. First, short-term accruals. Short-term accruals refer to short-term timing differences between income and cash flow. Then, long-term accruals. Long-term accruals arise from capitalization. Relevance of accrual accounting. The conceptual superiority of accrual accounting over cash flows arises because the accrual-based income statement is more relevant for measuring a company's present and future cash-generating capacity. Both short-term and long-term accruals are important for the relevance of income compared to cash flow, as described here. First, Relevance of short-term accruals. Short-term accruals improve the relevance of accounting by helping record revenues when earned and expenses when incurred. These accruals yield an income number that better reflects profitability and also creates current assets and current liabilities that provide useful information about financial condition. Next is relevance of long-term accruals. To see the importance of long-term accruals, note that free cash flow to the firm is computed by subtracting investment in long-term operating assets from operating cash flow. Such investment pose problems for free cash flow. First, these investments are usually large and occur infrequently. This induces volatility in free cash flow. Second, free cash flow treats capital growth and capital replacement synonymously.
Next is concept of income. Income summarizes the net effects of a business operations during a given time period. It is the most demanded piece of company information by the financial markets. Conceptually, income purports to provide both a measure of the change in stockholders' wealth during a period and an estimate of a business' current profitability, that is, the extent to which the business is able to cover its cost of operations and earn a return for its shareholders. Accounting income is different from economic income. This is because accountants use different criteria to determine income. Next is economic concepts of income. Economic income is typically determined as cash flow during the period plus the change in the present value of expected future cash flows, typically represented by the change in the market value of the business net assets. This concept of income is similar to how we measure the return on a security or a portfolio of securities. That is, return includes both dividends and capital appreciation. However, because of its comprehensive nature, economic income includes both recurring and non-recurring components and is therefore less useful for forecasting future earnings potential. Next, permanent income. Permanent income or recurring income is the stable average income that a business is expected to earn over its life, given the current state of its business conditions. Permanent income reflects a long-term focus. Unlike economic income, which measures change in company value, permanent income is directly proportional to company value. Next, operating income. Operating income, which refers to income that rises from a company's operating activities. The key feature of operating income is that it excludes all expenses that arises from the business financing activities, such interest expense and investment income, which collectively are called non-operating income. Operating income is an important concept in valuation. Its importance arises from the goal of corporate finance to separate the operating activities of the business from the financing activities. Conceptually, operating income is distinctly different concept to that of permanent income. Operating income may include certain non-recurring components such as restructuring charges, while recurring components such as interest expense are excluded from operating income. Next, accounting concept of income. Accounting concept or reported income is based on the concept of accrual accounting. While accounting income does reflect aspects of both economic income and permanent income, it does not purport to measure either income concept. Also, accounting income suffers from measurement problems that reduce its ability to reflect economic reality. A main purpose of accrual accounting is income measurement. The two major processes in income measurement are revenue recognition and expense matching. Revenue recognition is the starting point of income measurement. The two necessary conditions for recognition are that revenues must be first realized or realizable. For revenue to be recognized, a company should have received cash or a reliable commitment to remit cash, such as a valid receivable. And second, earned. The company must have completed all of its obligations to the buyer, that is, the earning process must be complete. Once revenues are recognized, related costs are merged with recognized revenues to yield income. And here are some reasons accounting income differs from economic income. First, alternative income concepts. Second, historical cost. Third, transaction basis. Fourth, conservatism. And last but not least is earnings management. We note that accounting income attempts to capture elements of both permanent income and economic income, but with measurement error. Accordingly, it is useful to view accounting income as consisting of three components. First, permanent component, second, transitory component, and third, value irrelevant component. Analysis implications. Adjusting accounting income is an important task in financial analysis. Before making any adjustments, it is necessary to specify the analysis objectives. In particular, it is important to determine whether the objectives is determining economic income or permanent income of the company. This determination is crucial because economic income and permanent income differ in both nature and purpose, and accordingly, the adjustments necessary to determine its measure can differ substantially. Next, fair value accounting. Broadly, fair value means market value. The terminology of fair value was coined because even if a primary market does not exist for an asset or liability from which market prices could be readily determined, one could still estimate its fair value by reference to secondary markets or through the use of valuation techniques. We know that other than fair value accounting, there is historical cost accounting. So what's the difference between these two models? First, transaction versus current valuation. Under historical cost accounting, asset and liability values are largely determined by a business entity's actual transaction in the past. The valuation need not reflect current economic circumstances. In contrast, under the fair value model, asset or liability amounts are determined by the most current value using market assumptions. The valuation need not be based on an actual transaction. Second, cost versus market-based. Historical cost valuation is primarily determined by the cost incurred by the business, while under the fair value model, it is based on market valuation. Third, alternative income approaches. Under the historical cost model, income is determined by matching costs to recognized revenues, which have to be realized and earned. Under the fair value model, income is determined merely by the net change in fair value of assets and liabilities. Hierarchy of inputs. Standard setters have established a hierarchy of fair value inputs. At the outside, two types of inputs are recognized. First, observable inputs, where market prices are obtainable from sources independent of the reporting company, and second, unobservable inputs, where fair values are determined through assumptions provided by the reporting company because the asset or liability is not traded. Observable inputs are further classified based on whether the prices are from primary or secondary markets. This gives rise to the following three-step hierarchy of inputs. Level 1 inputs. These inputs are quoted prices in active markets for the exact asset or liability that is being valued, preferably available on the measurement date. Level 2 inputs. These inputs are either first quoted prices from active markets for similar but not identical assets or liabilities, or second quoted prices for identical assets or liabilities for markets that are not active. Level 3 inputs. These are unobservable inputs and are used when the asset or liability is not traded or when traded substitutes cannot be identified. And there are three basic approaches to valuation. First, market approach, second, income approach, and third, cost approach. Fair value also has some advantage and disadvantage. And here are some of the advantage. First, reflects current information. Second, consistent measurement criteria. Third, comparability. Fourth, non-conservative bias. And fifth, more useful for equity analysis. And the major disadvantage of fair value accounting are First, lower objectivity. Second, susceptibility to manipulation. Third, use of level 3 inputs. Fourth, lack of conservatism. And fifth, excessive income volatility. Next, introduction to accounting analysis. Accounting analysis is the process of evaluating the extent to which a company's accounting numbers reflect economic reality. Accounting analysis is an important precondition for effective financial analysis. This is because the quality of financial analysis and the inferences drawn depends on the quality of the underlying accounting information, the raw material for analysis. And why we need accounting analysis? There are two reasons. First, accrual accounting improves upon cash accounting by reflecting business activities in a more timely manner. And second, financial statements are prepared for a diverse set of users and information needs. And next, accounting distortions. Accounting distortions are deviations of reported information in financial statements from the underlying business reality. These distortions are first accounting standards. Accounting standards are sometimes responsible for distortions. At least three sources of this distortion are identifiable. First, accounting standards are the output of a political process. A second source of distortion from accounting standards arises from certain accounting principles, and a third source of distortion is conservatism. Second, estimation errors. Accrual accounting requires forecasts and other estimates about future cash flow consequences. Use of these estimates improve the ability of accounting numbers to reflect business transactions in a timely manner. Still, these estimates yield errors that can distort the relevance of accrual accounting numbers. Third, reliability versus relevance. Accounting standards trade off reliability and relevance. An emphasis on reliability often precludes recognizing the effects of certain business events and transactions in financial statements until their cash flow consequence can be reasonably estimated. And fourth, earnings management. Earnings management is probably the most troubling outcome of accrual accounting. Use of judgment and estimation in accrual accounting allows managers to draw on their inside information and experience to enhance the usefulness of accounting numbers. There are two broad areas of accounting analysis. First, evaluating earnings quality and adjusting financial statements. There are four steps in evaluating earnings quality. First step is identify and assess key accounting policies. Second step is evaluate extent of accounting flexibility. Third, determine the reporting strategy. And fourth, identify and assess red flags. And last is adjusting financial statements. There are some common adjustments to financial statements. First, capitalization of long-term operating leases with adjustment to both the balance sheet and income statement. Second, recognition of ESO expense for income determination. Third, adjustments for one-time charges such as impairments and restructuring costs. Fourth, recognition of the economic status of pension and other post-retirement benefit plans on the balance sheet. And fifth, removal of the effects of selected deferred income tax liabilities and aside from the balance sheet. Okay guys, that's all for the video. Thanks for watching. Bye!